On the evening of August 15, 1971, American families gathered around their television sets for what they expected to be a normal Sunday night. Instead, President Richard Nixon appeared on screen with an announcement that would quietly reshape the global economy. He was closing the gold window. For ordinary citizens, the words sounded technical. But what happened that night would eventually touch every savings account, every mortgage payment, and every price tag in the world. I understand why that moment mattered. We must go back 27 years. In July 1944, delegates from 44 nations met at the Mount Washington Hotel in Bretton Woods, New Hampshire. World War II was still being fought, but these representatives were already planning the peace. They had witnessed the financial chaos of the 1930s. They had seen competitive currency devaluations destroy trade between nations. They had watched economic disorder feed political extremism. The delegates designed a new system. At its center was a simple promise. The United States would fix the value of the dollar to gold at $35 per ounce. Other nations would fix their currencies to the dollar. If a foreign central bank held dollars and wanted gold instead, the United States Treasury would exchange them. This arrangement required the United States to maintain substantial gold reserves. At Fort Knox in Kentucky and at the Federal Reserve Bank of New York, the system worked because the world believed in it. In 1945, the United States held roughly two-thirds of the world's official gold reserves. American factories were undamaged by war. American institutions were stable. The dollar became the foundation of international trade and finance. For more than 2 decades, the Bretton Woods system provided stability. European economies rebuilt. Japan industrialized. International trade expanded. Central banks in London, Paris, Frankfurt, and Tokyo held their reserves in dollars, confident they could convert them to gold if necessary. But by the mid-1960s, quiet pressures were building. The United States was fighting an expensive war in Vietnam. President Lyndon Johnson had also launched ambitious domestic programs called the Great Society, expanding healthcare and education spending. These commitments required substantial government expenditure. Rather than raising taxes to fully cover these costs, the government ran budget deficits. The Federal Reserve, America's central bank, kept interest rates relatively low to support economic growth. This policy encouraged borrowing and spending. It also meant that dollars were leaving the United States faster than they were returning. American companies were investing heavily overseas. American tourists were traveling to Europe in growing numbers. The United States was importing more goods than it was exporting. All of this meant dollars were accumulating in foreign hands. For foreign central banks, this created a question. They held growing piles of dollar reserves. Should they continue to trust these paper claims, or should they ask for gold? In Paris, President Charles de Gaulle was skeptical. France had been rebuilding its own gold reserves since the 1950s. In 1965, de Gaulle publicly questioned the fairness of a system that allowed America to run deficits while other nations had to maintain discipline. French officials began converting dollars to gold. Other nations watched carefully. The gold was stored deep in the vaults beneath the Federal Reserve Bank of New York and at Fort Knox. Throughout the late 1960s, these reserves were slowly declining. In 1957, the United States held over 22,000 metric tons of gold. By 1968, this had fallen below 10,000 tons. American officials tried to manage the situation carefully. In 1968, they established a 2-tier gold market. Official transactions between central banks would continue at $35 per ounce. But private market gold could trade at whatever price buyers and sellers agreed upon. This was meant to reduce pressure on official reserves. It was not enough. In the spring of 1971, the situation became critical. The United States trade deficit was widening. Inflation was rising above 4%. Foreign central banks were looking at their dollar holdings with increasing concern. West Germany was receiving enormous inflows of dollars as investors sought a more stable currency. The German Bundesbank faced a difficult choice. Continue buying dollars to maintain the fixed exchange rate, or let the Deutschmark rise in value. On May 5, 1971, Germany stopped defending the fixed exchange rate. The Deutschmark began to float upward. Switzerland and Austria followed. These were not dramatic announcements. They were technical adjustments by central banks. But they signaled that the system's foundations were cracking. Through the summer of 1971, President Nixon and his advisors held quiet discussions. The Treasury Secretary, John Connally, was a confident Texan who believed America needed to act decisively. Paul Volcker, then Undersecretary for Monetary Affairs, understood the technical complexities of international finance. Arthur Burns, the Federal Reserve Chairman, worried about inflation, but also about unemployment. They faced an uncomfortable reality. Foreign central banks and governments held more dollars than the United States had gold to cover. If several major nations demanded conversions simultaneously, the gold reserves would be insufficient. The $35 peg could not hold. By early August, the pressure was becoming public. Financial newspapers were speculating about currency realignments. Foreign exchange traders were testing the limits of the fixed rates. The situation required a decision. On Friday, August 13th, Nixon gathered 15 advisors at Camp David, the presidential retreat in Maryland's Catoctin Mountains. The group included Connally, Volcker, Burns, and other senior economic officials. They would spend the weekend deciding the future of the international monetary system. The meeting was secret. The press was told the president was spending a quiet weekend reviewing domestic policy. But inside the wooden cabins of Camp David, American officials were preparing to break the promise that had anchored global finance for a generation. They decided that weekend would be announced 2 days later. And when Nixon spoke to the American people on that Sunday evening, he would be changing rules that had seemed permanent. The gold window was about to close. The conversation at Camp David that August weekend was direct and practical. The advisors understood they were not simply making a policy adjustment. They were ending a system. John Connally argued for decisive action. He believed that the United States should not allow foreign governments to dictate American monetary policy by threatening gold conversions. Paul Volcker, who had spent years working on international monetary cooperation, knew this would anger America's allies. But he also recognized the arithmetic was unsustainable. Arthur Burns, the Federal Reserve Chairman, raised concerns about inflation. Closing the gold window removed a discipline on monetary policy. Without gold backing, what would prevent excessive money creation? But Burns also understood that defending the $35 peg was draining reserves that America might need in a genuine emergency. The group discussed additional measures. They agreed on a 90-day freeze on wages and prices to control inflation. They planned a 10% surcharge on imports to reduce the trade deficit. These would accompany the main decision, suspending gold convertibility. By Sunday afternoon, the plan was finalized. Nixon would address the nation that evening. At 9 o'clock Eastern Time, the president appeared on television. He spoke for 18 minutes. He framed the decision as protecting American workers and families from international speculators. He said the United States would temporarily suspend the convertibility of dollars into gold. The word temporarily would prove misleading. The gold window would never reopen. Most Americans watching that night did not grasp the significance. The speech focused on the wage and price controls and the import surcharge, measures that seemed more immediately relevant to household budgets. The gold announcement sounded technical, something for bankers and economists to worry about. But in financial centers across the world, the reaction was immediate. Monday, August 16th, was a day of confusion. Foreign exchange markets did not know how to price currencies without the fixed dollar anchor. Many markets simply closed rather than attempt trading in such uncertainty. Central bank officials in Europe and Japan were calling their American counterparts, seeking clarification. Was this truly just temporary? What would replace the Bretton Woods system? The British pound, the Deutschmark, the Japanese yen, and other major currencies were suddenly unmoored. Without fixed rates to the dollar, they began to float, their values determined by market forces. Currency traders, a relatively small profession in 1971, suddenly had enormous influence. Gold prices in private markets began to rise. If $35 per ounce was no longer the official rate, what was gold actually worth? By the end of August, private gold was trading above $40 per ounce. It would continue climbing. For ordinary people, the immediate effects were subtle. The dollar in their wallet looked the same. Prices in stores did not change overnight. But slowly, the consequences began to appear. Import prices started rising because of the 10% surcharge. American companies that relied on foreign components faced higher costs. International travelers found that their dollars bought less foreign currency than before. The Nixon administration worked to present the changes as a success. Secretary Connolly famously told concerned European finance ministers that the dollar is our currency, but it's your problem. The statement reflected a hard truth. The United States could make decisions unilaterally, and the rest of the world would have to adjust. Through the fall of 1971, finance ministers from the world's major economies negotiated a new arrangement. European nations and Japan wanted the dollar devalued significantly. The United States wanted smaller adjustments and more burden sharing. In December 1971, they reached an agreement at the Smithsonian Institution in Washington. The dollar would be devalued from $35 per ounce of gold to $38 per ounce. Other currencies would be revalued upward relative to the dollar. The range within which currencies could fluctuate was widened slightly. President Nixon called it the most significant monetary agreement in the history of the world. But the Smithsonian Agreement did not restore the old system. Gold convertibility remained suspended. The $38 price was theoretical, not operational. Central banks were still expected to maintain currency values through intervention, but the commitment was weaker. For retirement savers, the uncertainty was troubling. Many had assumed that the dollar's value was permanent because it was backed by gold. Now that backing was gone, at least temporarily. What did this mean for savings accumulated over decades? Financial advisors struggled to provide reassurance. Small business owners who imported goods faced unpredictable costs. A company that ordered manufacturing equipment from Germany in November might find that the price in dollars had changed by the time payment was due in February. Currency volatility created new risks for ordinary commerce. The Smithsonian Agreement held for slightly more than a year. Through 1972, the same pressures that had broken Bretton Woods continued. American inflation remained above 4%. The trade deficit persisted. Foreign central banks again accumulated dollars they did not want. In February 1973, the United States devalued the dollar again, this time to $42 per ounce of gold. But this adjustment also failed to restore stability. By March 1973, the major industrial nations gave up on fixed exchange rates entirely. The currencies of the world's largest economies would float. Their values would be determined by markets, by trade flows, by interest rates, by inflation differences, and by investor confidence. The system born at Bretton Woods in 1944 was finished. The system that would replace it was still forming. Central banks now faced new responsibilities. Instead of defending a fixed parity, they would manage floating currencies. This required different tools and different judgments. The Federal Reserve, the European Central Bank's predecessors, the Bank of Japan, and other monetary authorities would have to learn new approaches. For the global financial system, the ground had shifted. The rules established after World War II no longer applied. What would take their place was unclear. The next several years would reveal the costs and benefits of this new monetary world. The impact on everyday life would take time to become fully visible, but the direction was set. Money itself had changed. By mid-1973, the major currencies were floating freely against each other. There was no going back to Bretton Woods. The gold standard, which had governed international monetary relations for generations, was now history. The immediate consequence was volatility. Currency values shifted daily based on economic news, trade balances, and market sentiment. A Japanese company exporting electronics to the United States could not know for certain what its dollar revenues would be worth in yen next month. A German family planning a vacation to America could not predict how many Deutschmarks they would need for their trip. This uncertainty affected international trade. Companies began buying currency hedges, financial contracts that protected them against exchange rate movements. Banks developed new foreign exchange services. An entirely new layer of financial activity emerged simply to manage currency risk. But the deeper effects were in monetary policy itself. Without gold convertibility, central banks had more freedom. They were no longer constrained by the need to maintain a fixed exchange rate or protect gold reserves. The Federal Reserve could lower interest rates to fight unemployment without worrying about gold outflows. The Bank of England could raise rates to control inflation without fearing it would trigger a currency crisis under fixed parities. This flexibility came with a cost: discipline. Through the 1970s, inflation accelerated in the United States and many other developed nations. In 1973, the first oil shock hit as Arab oil producers reduced supply and quadrupled prices. American gasoline prices jumped, heating bills surged. The cost of transportation rose, pushing up prices throughout the economy. Inflation, which had been around 4% in 1971, reached 12% by 1974. Workers demanded higher wages to keep pace with rising prices. Businesses raised prices to cover higher wage costs. The cycle fed itself. Economists called it stagflation. Stagnant growth combined with high inflation. It contradicted the prevailing theories of the time, which assumed inflation and unemployment moved in opposite directions. The 1970s showed they could rise together. Retirees on fixed pensions watched their purchasing power erode. A monthly pension of $500 in 1971 could buy much less by 1978. Savings, accounts paid interest, but often not enough to keep pace with inflation. Millions of older Americans found their retirement plans undermined by currency depreciation they had not anticipated. Homeowners with fixed-rate mortgages actually benefited. They borrowed in $1,970 and repaid in $1,980 that were worth much less. But new home buyers in the late 1970s faced interest rates above 10%. Pricing many families out of the housing market, small businesses struggled with unpredictable costs. A restaurant owner could not easily plan menu prices when the cost of imported coffee, sugar, or cooking oil might change significantly within months. Some businesses simply stopped planning long-term, focusing instead on immediate survival. The instability eventually forced a response. In 1979, Paul Volcker, who had been at Camp David in 1971, became chairman of the Federal Reserve. He decided to break inflation even if it meant causing a recession. The Fed raised interest rates dramatically, eventually above 15%. The medicine worked, but painfully. The American economy fell into a severe recession in 1981 and 1982. Unemployment rose above 10%. Factories closed, farmers defaulted on loans. But inflation came down, falling to around 4% by 1983. The Volcker shock demonstrated that, without gold backing, monetary discipline had to come from institutional credibility and political will. Central banks had to convince the public they would control inflation even at significant economic cost. This lesson reshaped central banking worldwide. Through the 1980s and 1990s, central banks gained independence from political pressure. They adopted explicit inflation targets. They built reputations for responsible policy. The discipline that gold once provided had to come from institutional design and public trust. The end of the gold standard also changed the role of the dollar. Without gold backing, why should the world continue using dollars for international trade and reserves? The answer was inertia, market size, and lack of alternatives. The United States had the largest economy, the deepest financial markets, and the strongest military. Nations continued holding dollars not because of gold, but because of American economic and political power. This gave the United States what economists call an exorbitant privilege. America could run trade deficits and borrow in its own currency, without the constraints other nations faced, but it also created resentment and periodic calls for a new international monetary system. Over the following decades, the world adapted to floating currencies. Financial markets developed sophisticated tools for managing currency risk. International institutions like the International Monetary Fund evolved to provide support during currency crises rather than enforcing fixed rates. The system that emerged was more flexible than Bretton Woods, but also more prone to instability. Currency crises in Latin America in the 1980s, in Asia in 1997, and in Europe in 2010 showed that floating rates did not eliminate monetary problems. They simply changed their nature. For ordinary people, the post-1971 monetary system meant living with inflation risk in a way previous generations had not. It meant understanding that the value of savings could erode. It meant that international economic forces, often invisible and poorly understood, could affect household budgets. But it also meant that economic policy had more room to respond to crises. When the 2008 financial crisis hit, Central banks could cut interest rates aggressively without worrying about gold reserves. They could create money to prevent bank failures. These tools might not have been available under the gold standard. Looking back, August 1971 marked the end of commodity money in the modern world. For thousands of years, money has been linked to physical objects: gold, silver, and bronze. After 1971, money became purely a social agreement, backed by government authority and institutional credibility. This shift transferred enormous responsibility to central bankers and finance ministers. Without the automatic discipline of gold, they had to provide discipline themselves. Sometimes they succeeded, sometimes they fail. The history of money since 1971 has been the history of learning to manage that responsibility. The system is still evolving. New challenges emerge with digital currencies, with rising government debts, with shifting economic power toward Asia. But the fundamental change happened that August evening in 1971, when an American president closed a window that had connected paper money to physical gold. What seemed like a temporary emergency measure became permanent. The world moved forward into a new monetary age, one where trust in institutions replaced gold as the foundation of value. That transformation continues to shape economic life more than 50 years later, touching every transaction, every savings decision, and every government budget around the world. Subscribe for more deep financial history documentaries.